Catching a falling knife in the stock market is usually a great way to wreck a portfolio, but there is a specific, heavily tested pattern that forms at the bottom of a crash, boasting a 95% success rate in bull markets. The intuition behind this is straightforward. We're looking for 2 consecutive weeks of aggressive selling, where institutional buyers immediately step in, absorbing the panic and forging a rock-solid price floor. This chart shows the absolute prerequisite for finding this setup. You must set your time frame to the weekly scale. Applying this logic to daily charts introduces far too much noise and triples the failure rate to nearly 20%. The visual foundation is built on a prior downtrend that ends abruptly in 2 adjacent downward-pointing price spikes. Notice how these 2 weeks have nearly identical lengths and a massive price overlap. Identifying these overlapping spikes provides the initial signal. We then use specific filters to exclude the weak setups. The first filter is the sore thumb rule. A true pipe must feature downward price spikes that are dramatically longer than the average weekly volatility over the past year. They need to stand out completely from the surrounding price action. Next, check the trend context. As a reversal pattern, the setup must appear at the end of a clear, established downtrend. Market conditions also dictate your expected returns. While the pattern works in bear markets, trading this setup during a broader bull market yields significantly higher average gains, pushing the average rise to 45%. Then we look at the volume signature. The highest probability setups show heavier than average trading volume on the left spike, followed by relatively lighter volume on the right. To further stack the odds, look for an inside week. This happens when the right spike's entire high-to-low price range is completely contained within the vertical boundaries of the left spike. When you combine massive relative size, a preceding downtrend, and precise volume dynamics, you are looking at true institutional accumulation. But not every pair of spikes is a reliable floor. Take a look at this chart. We see 2 downward spikes, yet immediately after, the price collapses. The setup failed because the spikes aren't unusually large. They blend right in with the surrounding weekly volatility. Furthermore, the volume pattern is completely erratic, lacking heavy institutional buying on the left spike. So imagine you spot a setup that passes every single visual and volume test. The second week closes. Do you pull the trigger and hit the buy button? No. Buying right here falls into the most common trap of this strategy, premature entry. You must wait for price confirmation. The trade is only valid when a subsequent weekly candle officially closes above the highest high of the entire 2-week pipe pattern. Mandating that confirmation close is your single greatest defense against buying into a failing setup. Let's walk through a live execution using this multi-year chart of Bank America. After the 2 massive spikes form, we wait. The moment the weekly price closes above the pattern's high, our entry is triggered. Before entering the position, we place a hard stop loss. This goes roughly half a point below the absolute lowest tip of the 2 spikes. Give the trade breathing room, because about half the time price will experience a throwback. It temporarily drifts down to retest lows. As long as your stop isn't breached, hold firm and let the support level do its job. Combining these entry rules with rigid stop losses creates a systematic, risk-managed trade. To recap, 1. Stick to the weekly chart. 2. Look for a prior downtrend. 3. Find unusually long overlapping spikes. 4. Check for heavier volume on the left. And 5. Wait for the price to confirm the breakout. Remember, no pattern works 100% of the time, and all trading involves the risk of loss. Mastering strict rule-based filters is exactly what separates emotional gambling from systematic trading.